Most people hear the term long-term investing and immediately think, just buy a stock and forget about it for decades. That's what I thought too when I started. It sounds simple, it sounds easy, and honestly, it sounds safe. But the truth is, long-term investing isn't a passive magic trick. It's a practice, a habit, and a mindset. Welcome to Aaron's Money Manual, where we simplify money so you can stress less, live more, and make your hard-earned cash actually work for you. If you like beginner-friendly investing explained clearly, without hype or confusing jargon, make sure to subscribe for weekly videos. When most people hear long-term, they imagine decades and 20, 30, 40 years. And yes, time matters. But here's the thing. Long-term investing isn't just about holding a stock forever. It's about how your money behaves over time, through the ups, the downs, and everything in between. A lot of beginner investors make the mistake of thinking they've mastered long-term investing if they just buy a stock and ignore it. But real-life long-term investing is about staying consistent, making smart choices, and handling volatility without panicking. Think about it this way. Your portfolio will fluctuate. Stocks fall, markets crash, headlines scream doom. If you can't stay calm when that happens, your long-term strategy won't last as long as you think. Time alone doesn't create wealth. Consistency and patience do. One of the hardest parts of long-term investing is emotion. When your portfolio drops 20%, 30%, or even 50%, it can feel like your money is disappearing. But in reality, it's just a temporary shift in value. Emotional reactions are why so many investors fail. Selling in panic, chasing hype, or obsessing over daily price movements undermines the very strategy long-term investing promises. Real-life long-term investing is about staying the course. That doesn't mean ignoring everything. Review your portfolio occasionally, rebalance when necessary, and keep an eye on fundamentals. But it does mean resisting the urge to react to every headline or tweet. The real power of long-term investing comes from compounding. When you reinvest gains, dividends, or profits, your money starts making money on top of money. That's why even small contributions over a long period can grow into significant wealth. For example, imagine two investors. Both start with $10,000. One invests in a growth-focused portfolio earning an average of 8% per year. The other invests in a similar portfolio, but withdraws any gains to spend or pay taxes each year. After 30 years, the first investor could have more than 6 times as much as the second, even though they started with the same money and the same returns on paper. This is why long-term investing isn't about timing the market or chasing trends. It's about staying invested long enough for compounding to work its magic. Here's a common misconception. Long-term investing eliminates risk. It doesn't. Markets are unpredictable, companies can fail, economies can collapse. But long-term investing reduces the impact of short-term volatility. The key is understanding your risk tolerance and choosing investments that align with your goals. For example, stocks historically outperform bonds over decades, but they're also more volatile. Bonds may be steadier, but they grow more slowly. A real-life, long-term strategy blends both, adjusting as your life stage and goals change. The takeaway, long-term doesn't mean safe forever. It means being strategic, patient, and disciplined while accepting some level of risk. Consider companies like Apple, Microsoft, or Amazon. Early investors didn't just buy and forget, they weathered recessions, dot-com crashes, and market panics. Their commitment, not magic luck, allowed their investments to grow exponentially over decades. Index funds work the same way. They track the broader market, which includes growth and dividend-paying companies. By staying invested and contributing regularly, even ordinary investors can see extraordinary results. It's important to realize that long-term isn't only for billionaires or finance professionals. Anyone who consistently invests, keeps learning, and stays patient can see meaningful results over time. So how do you actually practice long-term investing in real life? Start today, even with small amounts. Time compounds faster than you think. Automate contributions. Regular deposits remove emotion from the equation. Ignore short-term noise. Headlines, Reddit hype, and daily stock movements won't matter in 10 years. Pick investments that fit your goals and risk tolerance. Diversification matters more than picking the next hot stock. Review, rebalance, and adapt as life changes. Long-term investing is a journey, not a set-it-and-forget-it sprint. Remember, the goal isn't perfect returns. It's consistent progress over time, managing emotions, and taking advantage of compounding. Long-term investing in real life isn't glamorous. It's not exciting. It's not a get-rich-quick scheme, but it works. It rewards patience, discipline, and consistency. The earlier you start, the more you benefit, not just financially, but mentally too. It teaches you how to stay calm during uncertainty, how to avoid impulsive decisions, and how to think in decades instead of days. Anyone can practice it, and anyone can succeed if they start now and stick with it. The strategies are simple, but the results are extraordinary. Keep learning, stay disciplined, and let time and compounding do the work for you. Thank you for watching Aaron's Money Manual. I really appreciate you being here and taking the time to learn how investing actually works. Keep it simple, stay consistent, and watch your money grow over time. Explore the channel for more beginner-friendly investing breakdowns and practical money content, and I'd love to have you back for the next one. Thank you again for watching, and I hope to see you next time.